let's move on to penalty-free 401k withdrawal is the next thing we were going to speak about. So, especially right now, I just did a video on TikTok where New York Times posted an article that more and more Americans are drawing from their 401k than ever. There was a CARES Act that kind of lightened the restriction on who can access that money. They took the penalty away for a while. As far as I understand, that penalty is now back, where the CARES Act has fell off, and now it's back to just the normal 401k withdrawal. So we're not talking we're not talking during the pandemic where a lot of regulations changed. We're talking about right now, how do you take a penalty-free 401k withdrawal without being penalized and paying the fine per se, or the penalty for accessing your own money within the plan when you need it for emergency, you lose your job, whatever the situation is. There's two rules specifically that give you the ability to do that. And Ron, explain to them what the 72T rule is with taking your money out of your 401k early.
Yeah, 72T applies. Again, we've talked about this before, that 59 and a half is that magic number. That's age. 59 and a half is your age. So prior to that age, if you go to exercise money out of a deferred plan like that, qualified plan like that, like a 401k, IRA, those types of things, there's a penalty, typically a 10% penalty on top of the tax because you've deferred that money. So you have to pay the 10% penalty plus the tax. Now, there's ways you can take loans. So before I get into the 72T, you can get into a loan. There's hardships that you can qualify for, and you can get loans from your 401k out. That does avoid the penalty. It does not avoid the tax, but it does avoid the penalty. But then you also have to pay that back. So there's a time frame of when that money has to be paid back to the plan. So you're taking money out, but those are hardships that you qualify for. So if you're just looking to take the money out because you need the money, maybe you still have a job, because a hardship is a loss of a job. But if you're still working, and just inflation, to your point, Will, that you're making, that, hey, things have changed. Coming out of this pandemic that was happening, there was a lot of things that transpired in terms of expense. Everything has gone up, from your grocery bill to your gas bill, your electric bill, all those types of things, gas in your vehicles, all those things have gone up. So people are having a hard time. A lot of people are having a hard time making ends meet. So when you go to take money out, that goes back to what you were saying, that CARES Act. They gave, in essence, a lag period there where there was no penalty to take money out of those plans. Again, you couldn't avoid the tax, but you weren't being penalized. You didn't have to worry about the hardship. The hardship was the pandemic and what they made at that CARES Act. Now we're back off of that again to where now those rules apply. So you get into what's called a 72T. You can do that under the age of 59 and a half to avoid the penalty. You can take monies out of those plans, but it's a percentage. It's based on your age. There's restrictions on how that's calculated. So it's a percentage of your money that you're allowed to take out. It's a small number. You're talking anywhere from like a 3 to 5%, depending on your age, and the dollar amount that you have sitting in there. It's that you avoid the penalty on that. So you're able to do that. It has to be classified as a 72T in order to avoid paying that penalty. So if it's not marked and classified that way, the IRS is going to come back to you and say, hey, you've taken money out of your 401k. You not only do you have that 1099, or at the end of the year that you've taken the money out, you now have to pay the tax and the penalty, which is 10%. And they may even charge you some interest on that also for penalty purposes. So the 72T is very, very specific in terms of the percentage that can be taken out. And there's a process in making that happen to classify that as a 72T. Otherwise, there's really no other way to avoid the penalty. Again, the hardships are there. There's some very particular hardship requirements in order to do that. But again, in that situation, it's a loan that you have to pay back. and it's very specific timetable wise, usually within about a 5-year period. But if you lose your job and you have a loan against it, the rules are different again in terms of you still owe money back on that loan. They're going to want that money back because you're no longer employed there. The contributions aren't there anymore. The plan is still there. You have to pay that money back. They don't forgive that. So there's very, very particular rules when it comes to exercising qualified funds. And that 72T is really one of the only ways to avoid the penalty. You can never avoid tax, but you can potentially avoid penalty under the age of 59 and a half.
And let's just be clear why you get a penalty, because the penalty is simply in place for you to not take your money out early. And the psychological part of it is people think, well, it's a good thing because I don't want to take my money out before I go to retire anyway. So the penalty it requires me to leave my money in so that I have money later in retirement. But the reality of it is the penalty is there so that they can handcuff your money so that later in life, when taxes are higher, they get the most taxes that they can pull off of your money. That's the reason for the penalty. And it's mind-blowing to me how many people don't realize that if a product comes with a penalty per se, and it's your money, how many people go through life and never have to touch that money? Very few. I mean, my father worked at a company for 20 years, ended up separating employment unexpectedly, and he had to cash out his 401k just to survive for a year or two. And he never really found a job that he was able to make the money that he was making at that time. So very few people go through life and never touch a 401k, like the reality of it. But the penalty is simply there so that they can get more taxation later in life than you would pay initially on that money now. Explain the 55-year rule. That's another way to access 401k withdrawal penalty free.
Yeah, just simply the age of 55. Once you pass that age, it gives you some flexibility. I mean, to make it very simple, it gives you some opportunity to exercise some money potentially without penalty. So that really, in theory, that's really all that it really is giving you that age, another restriction, another age, another ladder that you have to hit age-wise for something to occur for yourself. It gives you a little bit of flexibility to exercise some cash out of those types of plans. That's really, in a nutshell, what it is. Nothing more. Again, these are all restricted. Age is all predicated on these types of situations, and they just give you some of these, just like in a catch-up provision. Once you reach the age of 50 in these plans, you can contribute more than you could prior to age 50. The 55 just gives you another age that gives you something that gives you maybe a little bit of opportunity, if necessary, to attract and take some of that money out if necessary. Again, when we talk about, like you said, when there's penalties, restrictions, those types of things to monies, once you're in plans like that, you're in them. You can't. The only way to change the face of that is to basically convert. And in order to do that, you're paying all of the tax of that accumulated value now to change the face of that plan, to possibly not have to worry about taxes in the future or penalties like this. So I mean, there's a lot of restrictions on this. Again, not saying you don't do these types of things, but man, I think as a society, we are too involved in having the majority of our funds in these types of plans, because as we just described, there's age limits, there's restrictions. It's not truly liquid. You don't really have a lot of control. Yes, it's giving you some reduction in terms of your adjusted gross income to possibly change your tax liability for the current state that you're in. But overall, you can't have these cannot be the only plans that you're doing. There has to be some strategy that's put in place, and you got to think outside the box to try to put some things in place that are beneficial to you. This is really more than anything, we have to take control back. We allow too much control to be taken from us because we don't have the use, the control, the liquidity, the taxation. All those things are typically taken away and removed from us because of how these plans are formed and how they're based and the rules that they're run by. We have to change some of those strategies and put some of that control back in our own possession. And again, not saying you don't do these kind of things, but the majority of that, in my opinion, cannot be in those types of buckets.